Hey there, everyone. Welcome back. You are watching Insight. Look, it's almost tax time. Actually, look, I'm going to go ahead and say it. It's tax season, and that's what we're talking about today with Heather Foster of Foster Financial Services, always bringing us some great financial advice. Heather, I mean, look, tax time, I know your office is busy. Let's talk about some of that tax time contribution.
Yeah, so contributions are full in force. A lot of people wait to do their contributions into their IRAs or into their Roth IRAs until they're actually doing their taxes. And the reason why, Tony, is because we've got these phase outs. So again, with everything, the IRS and legislation changes makes everything a little bit complicated. So if you basically, between, let's say, a husband and wife, if you make less than $116,000 a year, that's where the phase out begins on traditional IRA contributions. So if you make less than that, you're eligible to contribute to an IRA outside of your employer plan, meaning you can save into your employer plan and you can also start saving into a traditional IRA. Now, why we tell people, hey, maybe why you want to save into an IRA versus your employer plan, a lot of times is because of the limitations with that employer plan. Sometimes the employer plans only have a limited, 13 funds to choose from. They're all mutual funds, as where a traditional IRA can be put directly in the stock market, and you've got the whole plethora of every stock and mutual fund and exchange traded fund available to choose from. So you can get typically better performance if you can get to those more strategic funds. So that's one reason why people save it that way. Plus, it's an IRA contribution. They're getting that tax write-off, so they don't have to pay the taxes on there because it's pre-tax money going in. So again, the phase out starts at $116,000. So if you make less than that, you're fully able to do an IRA contribution if you have earned income, meaning that you still have to be making money of some sort as an earned position, W-2, or maybe you're self-employed, but you have to be working to make those contributions. There is a phase out completely. And then also Roth IRAs, their phase out starts at $218,000. So if you make less than $218,000, you're eligible also to do Roth. Between the two of them, you can do no more than $6,500, Tony, for anyone that's under the age of 50, or up to $7,500 per person in that 1 year for people that are over the age of 50. So IRA contributions, again, it's pre-tax money. It's going to give you a tax deduction this year, and it's going to grow and cause you taxes later. Roth IRA contributions, you do not get a tax deduction for it, but it's a way of saving money into an account that will grow completely tax-free. And why we're talking about this, again, we're in tax time. So if you're somebody that maybe is on the cusp of making maybe between you and your spouse, you're going to make more than $116,000 or $218,000 for the Roth, and you're just not sure. A lot of times, again, people wait until they're doing their taxes to see where did their income fall and are they eligible to make these contributions. So if you find out you are eligible to make these contributions in these wonderful retirement accounts, make sure you work with your CPA to verify that you can in fact contribute, and you have until April 15th to do so. So a lot of people, Tony, contribute to these accounts as they're working, as the year's going on, because they're not close to these thresholds. But if you are someone that's close to the thresholds, maybe you're somebody that's looking at doing a contribution. Or maybe you just didn't even realize you were eligible to do a contribution. So you've got till April 15th of this year to make a contribution for 2023. So highly recommended. The other one I wanted just to mention, Tony, was HSAs. Yeah. So health savings plans. If you have an HSA health plan, you also get that April 15th deadline to put money into those HSAs. HSAs are a tax reduction, so it's a pre-tax account. It's actually the best kind of account because you put the money in and you get a tax write-off right away, and it also grows completely tax-free. So it's kind of like a hybrid of an IRA and a Roth IRA where you get the tax-free growth of the money, but you also get the tax deduction for that money to go into those accounts. So work with your CPAs, verify, do I have an HSA plan? Did I max it out? If you realize, hey, my employer put money in this plan, but I didn't actually max it out, there's a lot of tax advantages for you to potentially max that out, and you've got till that deadline to do IRA, Roth IRA, and HSA contributions.
And it's important to give their financial advisor a call. So, Heather, we appreciate you for always bringing us these wonderful tips. It's tax season. Don't wait until the last minute, right?
Exactly. Give your CPA and your financial advisor time to set up the accounts and get the contributions in.
Got it. Thank you so much, Heather, as always. Everyone, take a look at your screen right now. Find out more information about Foster Financial Services. Go ahead and book that complimentary consultation today. Go ahead and give them a call. You can also visit their website. We'll be right back.